In many respects, we have a two-speed economy here in New Zealand right now, where parts of the economy are seeing the benefits of quite significantly increasing export commodity prices, for example, in the dairy sector and the meat sector. So the parts of the country that are most exposed to that, particularly in the regions and outside the major urban areas, they've been doing quite well, really. Farmer confidence, for example, is at very high levels right now. But in the major urban areas, things are a lot tougher. So as you pointed out, job ads quite weak. The recent trend of jobs overall in the economy suggests that job shedding is still occurring at a gentle pace, but nevertheless still occurring. And with interest rates now sitting closer to 3% than 5%, with commodity prices remaining fairly well supported, we think that there will ultimately be a resumption in spending. We see a lot of indicators here suggesting that any sector that's more tightly related to tourism and the agricultural sector. I see it also in employment trends, where while for overall in the country, employment growth on a recent basis is still in negative territory. For the South Island, which has a much higher concentration of activities in the tourism sector and in the agricultural sector, there's actually positive jobs growth there. It's sort of like 1% on a sort of like a 3-month annualized basis in the South Island versus like a minus 2% job growth on the same basis for the North Island. And in many respects, I think that you see in these sort of cycles that the agricultural, the regions will lead the trends in the urban areas. We think it could be quite significant. Like the estimates that we've made for the impact of what is around about a 200 basis point fall in mortgage rates equates to, depending on if you're a first home buyer or an average borrower. Like for a first home buyer, it might be $500 or $600 a month. For first home buyer, for the average person, it might be closer to $300 or $400 a month. Some of that money won't go into spending, it'll be saved, or it might go into sort of repaying the mortgage a bit faster. So literally every day, New Zealand households are transitioning from what was a much higher interest rate to a lower one. So, once we get to the end of this year, we would expect that a large proportion of people will be on a rate much closer to 5% than 7%, which is presumably going to impact on household spending quite a bit. The investor segment is quite interesting. So they removed the bright line test, which basically meant that the post-tax returns associated with property investment improved relative to what would have otherwise been the case before. But, what I think has really kicked on the investor market has been the reduction in interest rates, because it's actually improved the hurdle rates that investors have to reach before they can contemplate a residential housing investment. We have a model where we try to quantify what the fundamental value might be of housing from an investor perspective. And the combination of the lower interest rates and the better taxation arrangements appear to have taken houses from an investor perspective from being somewhat overvalued to now somewhat undervalued. So we see that investors are basically responding to that signal, where they basically expect that certainly for some categories of the housing market, it will be advantageous for them to kind of like buy. I think it's particularly relevant for lower priced or smaller properties. There's been a real increase in things like townhouses and apartments constructed in New Zealand in the last few years. We have noticed when we looked at the statistics up until the most recent update that we got, I think there were 236 applications covering 766 people. It's important to note that probably towards a quarter of those applications have just shifted category from another investment category into this one. So it's not necessarily adding as many new applicants as the headline figures would suggest. In aggregate, the sort of minimum amount of new investment coming into the country is perhaps in the order of about $1.5 billion, which is really not too far off what we tended to see pre-COVID from overseas investors coming into the country, because there's always been categories of visa which were available for people wanting to come to the country who had reasonable resources. So, Now, when we consider that there's probably around 2.1 million private dwellings in the country, you're talking about a few hundred people at the margin. There certainly could be the possibility that for some real premium properties, there could be the odd, Singaporean billionaire or something like that